Hey guys, Market Muse here. The request of a friend who's new to trading. Today I'm going to talk to you about margin trading. Now we've all heard the warnings, never trade on margin, it's the quickest way to lose everything, it's not worth it, and so on. Granted, it can get confusing at first, but I wouldn't let that steer you away from learning about it. Always keep in mind, the more you know, the more confidence you'll build, and the less opportunities you'll miss. The point of margin trading is to provide you with leverage in your returns. What do I mean by that? So let's say you have $5,000 in cash as your equity in your account, but you would like to buy $10,000 worth of a stock or security. So you would then need to use $5,000 of margin. To make it simple, you can consider this as a loan from your broker. Let's say your position rises to $11,000 and you decide to sell, giving you $1,000 in profit minus any fees and after paying back the $5,000 in margin loan. Sounds great, right? However, margin trading is more risky than normal trading due to the leverage. So although you're earning $1,000 in profit in this scenario, what if your position went down to $1,000? When it's all said and done, your account equity would go down to less than $4,000 after paying back the $1,000 in net loss, $5,000 in margin, and any fees and commissions associated with that trade. So just be sure of what you like to do and always have a plan on your trade. And we'll discuss this at a later video. So now margin loans do not have any set of repayment schedule as you would with a regular loan, personal or what have you, but you're required to maintain a certain level of equity in your account. Think of this as collateral. This requirement varies and it's based on the type of security. For example, a stock usually has a maintenance requirement of 25%, and this may be higher depending on your broker and position size. This means that if you want to margin trade $10,000 of a stock with this requirement size, for example, you'll need to maintain 25% or $2,500 in your account as equity to begin with, and then maintain any further calls, which vary by broker and type of security. The longer you hold on to the position, the more calls you'll get throughout time. If your margin equity falls below the requirement amount due to the market value of the purchase security, or because you purchase additional securities in your account, you will get a margin call. This means that you will need to increase the equity in your account by adding cash or liquidating other securities you may hold. And now this is very important to keep in mind. If your account equity does not rise to the required amount by the due date of the margin call, the broker has every right to sell off any, if not all, securities you own in your account in order to increase the equity in your account so as to satisfy the margin call requirement. Also, something to point out, not all securities are eligible for margin, such as CDs and money markets. Now, people are familiar with buy low, sell high. However, this is profitable when the market or a particular security is increasing in value, right? So how about when there is an anticipated price decline ahead? This is where short selling comes into play. It offers the opportunity to sell at a higher price and buy back at a lower price in the future. So in Fidelity, similar to other brokers, when you create a trade, you want to switch the action to sell short. Then set up the quantity and the order type and so on. But before submitting your trade, have a look at the margin calculator and see how this trade order will impact your account equity and to ensure that you will meet the initial call requirements. When you go to the margin calculations for the account, you can add a transaction to the worksheet by selecting the type of security, symbol, type of trade, whether buy or sell, quantity, and price. You'll then get the percentage or value of margin requirement needed. For example, for AMD, if I were to buy or sell, I would need 35% of margin equity as a requirement to begin with. As far as short trading, you may be scratching your head and thinking, how does this work? How can you sell something you don't even have in the first place? Well, here's how. You borrow the shares through your broker, and this is why you need a margin account. to allow you to trade on credit. Once you are approved for this type of account through your broker, you can short the shares. Once you submit the order to short, let's say 200 shares of a stock, then the broker has to find 200 shares of on the investor's behalf, meaning you. And because the investor doesn't own the shares, these shares come from the broker's inventory, which can be positions owned by other investors in their books or third-party brokers. Once they're on hand, the order is sent to market for execution. The broker puts the proceeds of that sale into your account, minus any fees or commissions, and there you go. Shares are now into your account, and they show up as short. The margin calls can be tracked into your margin call summary. This will reflect any current or upcoming calls into your account. When you decide to get out of your short position, you then create a buy to cover. In other words, when you buy a stock, you buy shares, and to get out of the position, you sell the shares. But when you're shorting, you do the complete opposite. You sell the shares to get out of your position. You have to buy them. The net value of the two orders get reflected into your account as losses or profits, depending on the outcome of the trade. Now, I hope you found this video useful or informative. If so, give me a thumbs up. If you want to support the channel, give me a thumbs up and subscribe so we can grow together. If you have suggestions for future videos, please comment below, and I'll see you in the next one. Thanks.